STM just delivered the kind of quarter investors had been waiting for. Revenue jumped 26% year-over-year. Automotive and industrial markets are recovering, inventory is normalizing, margins are improving, and management now sees AI data center revenue exceeding $1 billion this year. So why did Wall Street still sell the stock? The answer is not that STM had a bad quarter. In fact, the underlying business is clearly getting better. The problem is that expectations moved even faster. Investors were no longer asking whether STM could recover. They were asking how quickly that recovery could translate into stronger earnings, higher margins, and a much bigger AI opportunity. And this is where the story gets interesting. The first mistake would be to look at STM's earnings and ask, were the numbers good? That is no longer the right question. Wall Street was looking at something much more demanding, whether STM was recovering fast enough to justify the expectations already embedded in the stock. That distinction explains the unusual reaction. Investors had already seen evidence of stronger automotive demand, industrial normalization, and a rapidly improving AI opportunity. So by the time earnings arrived, recovery was no longer a surprise. It had become the baseline expectation. What the market wanted was acceleration, stronger earnings conversion, faster margin expansion, and clearer evidence that the AI opportunity could materially change STM's growth profile. The quarter showed progress. But progress was no longer enough. The market wanted proof of acceleration. If recovery is no longer the surprise, then the next question is where that recovery is actually coming from. And this is where STM becomes more interesting. The improvement is not being driven by one isolated product or a single customer. Two of its most important end markets, automotive and industrial, are beginning to move in the same direction after a prolonged inventory correction. That matters because semiconductor downturns often end before investors can clearly see the recovery in reported earnings. First, customers stop cutting orders. Then inventories normalize. Then utilization improves. And only after that does operating leverage begin to appear. STM now appears to be moving through that sequence. The important question for investors is whether this is simply a cyclical rebound, or the beginning of a more durable earnings recovery. And automotive gives us the first important clue. Automotive may be one of the clearest signals that STM's downturn is beginning to reverse. But the important question is not simply whether customers are buying more chips again. It is whether the underlying demand environment has fundamentally improved. After the inventory correction, customers are becoming more willing to place orders for powertrain, ADAS, sensors, and application-specific chips. That suggests the recovery is moving beyond simple destocking. More importantly, STM continues to secure design wins, which can create revenue visibility well beyond the current quarter. But there is still a distinction investors need to make. A cyclical rebound can produce strong numbers for several quarters without creating a permanently higher growth trajectory. For STM, the real signal will be whether these new designs translate into sustained production volumes. And that brings us to the second part of the recovery, industrial. If automotive tells us that demand is returning, industrial tells us whether the semiconductor cycle is actually healing. For STM, one of the biggest problems was not simply weak end demand, but excess inventory sitting across the distribution channel. That forced customers to delay orders and kept pressure on utilization and margins. Now, that dynamic is changing. Distribution inventory has moved below STM's normal target, removing one of the major obstacles to a healthier order cycle. This matters because once customers are no longer focused on clearing old inventory, new orders are more likely to reflect real consumption rather than replacement timing. That makes the current recovery more credible. But there is still a missing piece. A recovery in demand is only valuable if STM can convert it into significantly better profitability. And that is where the earnings report becomes much more complicated. And this is where the market's disappointment becomes easier to understand. STM is showing evidence that demand is recovering, but investors are still asking a harder question: how much of that recovery is actually reaching the bottom line? Semiconductor companies can grow revenue while profitability remains constrained by factory utilization, product mix, manufacturing costs, and restructuring. That appears to be the tension at STM today. The business is moving in the right direction, but the earnings leverage investors expected has not yet fully arrived. This explains why a revenue recovery alone could not satisfy the market. Investors had already anticipated stronger demand. What they wanted to see was the next stage, revenue turning into significantly higher operating profit. And that makes margins the real battleground for STM from here. The next phase of STM's recovery will be decided by margins, not just revenue. During a semiconductor downturn, factories can remain underutilized while fixed costs continue to weigh on profitability. As demand returns, utilization should improve and those fixed costs can be spread across a larger revenue base. That is where operating leverage can become powerful. But STM still has to prove that this mechanism is working consistently. Product mix, manufacturing efficiency, restructuring costs, and pricing will determine how much incremental revenue actually becomes incremental profit. This is also why management's margin outlook matters more than a single quarterly number. If margin expansion accelerates alongside revenue, the market can begin to believe that STM's earnings recovery is becoming structural. If it remains slow, investors may continue to question the quality of the recovery. And then there is one factor that could change the equation entirely: AI. AI is becoming important to STM for a reason that goes beyond the headline revenue opportunity. STM does not need to compete with GPU leaders to benefit from the AI infrastructure build-out. Its exposure sits further down the stack, in areas such as power management, connectivity, and optical technologies that help data centers move and manage enormous amounts of information and electricity. That creates an interesting possibility. AI could add a new source of growth while STM's traditional automotive and industrial markets recover at the same time. But there is a catch. Once investors begin to believe AI can materially accelerate STM's growth, expectations rise very quickly. And that may be one of the most important reasons this earnings report felt disappointing. The better the AI story became, the higher the bar for STM became. AI may be STM's most exciting new opportunity, but it also changed the psychology around the stock. Before AI became a major part of the story, investors mainly needed evidence that automotive and industrial demand were recovering. Now the market is asking for something much bigger, proof that AI can accelerate STM's growth and eventually improve its earnings mix. That creates a higher hurdle. A strong quarter can still disappoint if investors were expecting an even stronger trajectory. This is the classic problem with a stock whose narrative improves faster than its reported earnings. The fundamentals may be getting better, while the expectations embedded in the share price are getting even better. So the sell-off does not necessarily mean investors have lost faith in STM. It may simply mean the market is forcing the company to earn back the optimism that had already been priced in. What makes STM's story interesting is that management does not sound cautious about the recovery. The tone has become increasingly confident around demand, bookings, inventory normalization, and the emerging AI opportunity. Management is also pointing toward stronger momentum in the second half, with AI data centers becoming an increasingly important contributor. That creates an unusual disconnect. The company is communicating better visibility and stronger demand, while the market is responding with skepticism. But management optimism alone is not enough. Investors have heard bullish forecasts before, especially in cyclical semiconductors. What matters now is whether STM can turn that confidence into revenue, margin expansion, and cash generation. The market is not necessarily rejecting management's outlook. It is demanding evidence. And that brings us to the real gap behind the sell-off. Now the pieces start to fit together. STM is recovering, management is increasingly optimistic, and AI is opening a potentially important new growth avenue. So why did investors still react negatively? Because the market had already moved beyond the recovery story. Expectations were built around faster earnings growth, stronger margin expansion, and a more immediate contribution from AI. STM delivered progress, but the progress did not fully match the speed investors had begun to anticipate. This is one of the most important lessons in equity markets. A stock can fall even when the underlying business improves. The question is always, better than what? In STM's case, the answer appears to be the problem. The company is getting better, but investors wanted the financial results to catch up with the narrative faster. Now the focus shifts away from what STM just reported and toward what it must prove next. So what would change the market's mind? Not another headline beat, but evidence that the recovery is becoming self-reinforcing. Investors will be watching whether automotive and industrial demand continue improving without another inventory correction. They will want to see whether higher utilization translates into sustained margin expansion, rather than a temporary rebound. And perhaps most importantly, they will watch whether the AI opportunity develops into meaningful, repeatable revenue instead of remaining a promising forecast. Management has set an ambitious path for the second half and beyond. Now execution becomes the story. If STM delivers stronger margins while AI and traditional end markets accelerate together, the market may begin to view today's sell-off differently. But if growth slows or profitability fails to follow, the skepticism will look justified. The next phase is about proof, not promises. So where does this leave STM? The evidence suggests the recovery is real. Automotive is improving, industrial demand is normalizing, inventory pressure is fading, and AI is creating a potentially powerful new growth avenue. Management is also signaling stronger momentum ahead. But the market has moved beyond simply asking whether STM can recover. It wants proof that recovery can accelerate, and that higher revenue can translate into stronger margins and earnings. That is the real tension behind this sell-off. The business may be improving, while expectations are still running ahead of the financial results. If STM delivers the acceleration management is pointing toward, today's disappointment could eventually look like an expectation reset. If it doesn't, Wall Street skepticism may prove justified. STM didn't disappoint because the recovery wasn't real. It disappointed because Wall Street wanted the recovery to happen faster. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.